studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
Now let's move from theory to practice and see how a capital dividend account is calculated in the real world. In this example, we'll follow DeMarco Family Holdings Inc. and track how its CDA balance changes over time. We'll begin with the first major transaction in 2017. During the year, the corporation sold a rental property and realized a capital gain of $652,000. As we've learned, only the non-taxable portion of a capital gain is added to the CDA. Since 50% of the gain is non-taxable, the CDA addition is $326,000. The corporation started with a CDA balance of zero. After adding the non-taxable portion of the gain, the CDA balance increases to $326,000. At this point, the corporation has accumulated a substantial amount of potential tax-free dividend capacity. But the story doesn't end there. Later, the corporation experiences a capital loss of $72,800. Remember, for CD purposes, we don't use the entire capital loss. Only the non-deductible portion affects the CDA. 50% of the loss, or $36,400, becomes a reduction to the CDA balance. As a result, the corporation's CD decreases from $326,000 to $289,600. This example illustrates one of the most important principles in CD calculations. Non-taxable capital gains increase the CDA. Non-deductible capital losses decrease the CDA. And because the CDA is a cumulative account, every qualifying transaction changes the running balance. By the end of these first two transactions, DeMarco Family Holdings Inc. has a CDA balance of $289,600. In the next slide, we'll see how a capital dividend received from another corporation further increases the CDA and creates even more tax-free distribution capacity. Let's continue the DeMarco Family Holdings example and look at one of the most valuable features of the Capital Dividend Account system: the ability to move tax-free amounts between corporations without losing their tax-free character. On the left side of the slide, we have Lightshine Sunrooms and Decks Limited, the operating company. At some point, the operating company sells a warehouse and realizes a capital gain. As a result, the operating company generates a CDA balance. Rather than leaving that CDA trapped inside the operating company, the company elects to pay a capital dividend. The capital dividend paid is $172,000. Now let's follow that dividend to the holding company. DeMarco Family Holdings Inc. receives the $172,000 capital dividend. And this is where a very important CDA rule applies. When a corporation receives a capital dividend from another Canadian corporation, that capital dividend generally increases the recipient corporation's CDA. In other words, the tax-free character of the amount is preserved. The money moves from one corporation to another, but it does not lose its CDA treatment. Let's see the impact on DeMarco Family Holdings Inc. At the end of the previous slide, the corporation had a CD balance of $289,600. After receiving the capital dividend of $172,000, the CDA balance increases to $461,600. Notice what happened. No taxable income was created. No additional tax was triggered. The CDA simply increased because a qualifying capital dividend was received. This is one of the reasons holding company structures are so powerful in Canadian tax planning. Tax-free amounts can flow from an operating company to a holding company while retaining their tax-free nature. You can think of the process as a relay race. The operating company generates the CDA. The operating company pays a capital dividend. The holding company receives the capital dividend, and that same tax-free amount becomes part of the holding company's CDA balance. Ultimately, the holding company may use that CDA balance to pay tax-free capital dividends to individual shareholders. The key takeaway from this slide is simple. Capital dividends received from another corporation increase the recipient corporation's CDA. And because the tax-free character is preserved, CDA balances can move through a corporate group without losing their tax advantages. In the next slide, we'll complete the entire calculation and determine the final CDA balance available for distribution to the shareholders of DeMarco Family Holdings Inc. Now let's complete the DeMarco Family Holdings example and see the final result. At this point, we've tracked all of the major transactions that affected the corporation's capital dividend account. Let's summarize them one by one. First, in 2017, the corporation sold a rental property and realized a capital gain of $652,000. The non-taxable portion of that gain was $326,000, which increased the CDA. Next, the corporation experienced a capital loss. The non-deductible portion of that loss was $36,400, which reduced the CDA balance. Then, in 2019, DeMarco Family Holdings received a capital dividend of $172,000 from Light Shine Sunrooms and Decks Ltd. Because capital dividends received increased the recipient corporation's CDA, that amount was added to the account. When we combine all of these transactions, the calculation becomes very straightforward. We start with a CDA addition of $326,000 from the capital gain. We subtract $36,400 from the capital loss, and we add $172,000 from the capital dividend received. The result is a final CDA balance of $461,600. This number is extremely important. Why? Because the final CDA balance represents the maximum amount that can potentially be distributed as a tax-free capital dividend. In other words, DeMarco Family Holdings now has the ability to elect and pay a capital dividend of up to $461,600 to its shareholders. And if the proper election is made, the shareholders can receive that amount completely tax-free. Notice the power of the CDA system. A capital gain was earned inside a corporation. A portion of that gain remained tax-free. That tax-free amount was tracked through the CDA. Additional CDA was created through an intercorporate capital dividend. And ultimately, the accumulated CDA balance can be passed to shareholders without creating another layer of personal tax. This example demonstrates why accurate CDA tracking is so important. Every capital gain increases the balance. Every qualifying capital loss reduces the balance. Every capital dividend received can increase the balance. And the final running total determines the corporation's tax-free dividend capacity. The key takeaway is simple. The capital dividend account is a cumulative account that must be tracked over time. The final balance is not just a number on a schedule. It represents a real opportunity to move corporate wealth to shareholders completely tax-free, which is one of the most valuable benefits available in Canadian corporate tax planning.